what I want to talk about is just what's going on. Why is it all of a sudden it seems that Bitcoin has woken up, from the dead and rallying? And why is Ethereum rallying and so many different coins?
This is the Demystifying Crypto and Building Wealth podcast.
I knew that would be worth trillions.
That had never existed in human history.
There's been massive opportunities.
The #1 podcast to help you understand and get insights into the crypto world, blockchain technology, wealth building, and financial investing. Now, here's your host, Tico Tawari, the world's #1 most trusted cryptocurrency analyst and Wall Street veteran with decades of experience in the financial space.
And the reason why is because interest rates have started to come in a little bit. If you look at the 10-year Treasury, the 10-year Treasury was yielding as high as 4.32%. It's now trading at 4%. I'm looking at the chart right now. It looks like it's going to come in a little bit. And so this is igniting a rally in so-called risk assets. If you allocate capital for a living, you're a money manager. You allocate your capital based upon certain models. And the most important input to any financial model is the risk-free rate of return. And the risk-free rate of return is generally the rate of interest paid on the 10-year Treasury. And so as a professional allocator of capital, what you have to do is you have to consciously always be aware of how much you can make risk-free relative to how much you can make taking risk. So if let's say normalized inflation is 2%, obviously it's not 2% now, but normalized inflation is 2%, and I can make 7% on investment grade bonds. Yes, 7% is still below the current rate of inflation, but remember, this is not Argentina. Our inflation will not stay at 8, 9, 10% forever. Eventually it will get fixed. Well, then as a capital allocator, I look at that and say, okay, I've got an investment grade bond. Investment grade bonds, they are virtually risk-free. They're not completely free of risk, but they will have a default rate or a rate of not paying. It's 0.1% per year, something like that, of investment grade bonds actually fail. So it's as close as you can get to a risk-free bond other than holding treasuries. So you look at that and you say, okay, I can get 7% for 20 years, essentially risk-free, versus an average market return of, let's say, 8 to 9% on the S&P 500. But I have to take all the risk involved with holding the S&P 500. So as rates go higher, capital gets sucked out of riskier assets. So it comes out of stocks, it comes out of crypto, it comes even out of certain types of housing, and it goes into bonds. And so that's what we've been seeing take place over the last few months. As interest rates have moved up, the models that capital allocators use to allocate their capital change. They say, okay, you've got to take your allocation into, let's say, high growth NASDAQ, no earnings companies down from 10% to 6%, or from 6% to 3%. And you've got to take your blue chip, low risk income producing stocks up to 36%. You've got to move your bond portfolio from 5% to 15%. And so this is happening at scale. And so the reason why this is important, why I'm giving you all that background, is because for the first time, we now have institutional capital in crypto assets. And so we have to pay attention to what they pay attention to. And so as interest rates move up, you have seen Bitcoin go down. You've seen Ethereum go down. You've seen the whole market go down because the allocation of the institutional capital has gone down. And so this is the kind of you got to take the good with the bad when you say, okay, we want institutions in our asset class, right? So we have to take the good with the bad. The good is when interest rates come down like they are now, what happens? Boom, we're off to the races. You have movements in, let's call them the two blue chips in the space, Ethereum and Bitcoin, that are far outpacing the movements you're seeing in stocks. So you'll see that on the way up and on the way down. And so as a trader, you look at this and you say, okay, how long do I think this is going to last? Well, I'm looking at interest, the chart on the 10-year Treasury right now, and it's coming right into support. Now, if that support doesn't hold, we could go to 3.75%, maybe 3.5% on the 10-year Treasury. If we do, knowing what I do of capital allocation suggests that we will see one heck of a rally in NASDAQ stocks and a heck of a rally in Bitcoin and Ethereum. But it's a long shot that interest rates drop that low, Cynthia, because if we look at what the Federal Reserve has said, they have at least intimated to the market that they are going to raise interest rates by 75 basis points in November and by 50 basis points in December. So if that's true, then that will put the Fed funds rate at somewhere around, that's 125 basis points, somewhere around 4.5%, somewhere in that range. So how can the 10-year Treasury be below the Fed funds rate? I don't think it can be. That doesn't make any sense to me. So what this looks like to me is more of a relief rally in equities, a relief rally in crypto. But unless interest rates stay low, I just don't see that rally having legs. And of course, nobody wants to hear that, right? Like, oh, you're the Bitcoin guy, bring out your pom-poms and tell us how great we're going to the moon. Look, if the 10-year Treasury drops to 3.75% or drops to 3.5%, you can see $30,000 Bitcoin like that, right? $2,500 Ethereum like that, because the allocation will change. Everyone knows, Cynthia, that once the Fed pivots, crypto is going to blow any other asset out of the water in terms of its returns. It's going to be incredible. We've seen that again and again. Anytime there's a slight hint that interest rates might come in, we see Bitcoin and Ethereum far outpace the Dow Jones Industrial Average, the NASDAQ, the S&P 500, every other, gosh darn asset that's out there. So, one of the ugly truths that we have to accept now as crypto investors is that, unfortunately, our fortunes are tied to the goddamn interest rate cycle. And that's something I never thought I'd ever see by owning Bitcoin. But unfortunately, if you want to have institutional participation in this asset, you're going to be victimized by certain things that victimize that space, and that is the price of money. Now, will that be that way forever? No, it won't. I think it's that way now because there is a very immature view of what this asset is, why this asset has value, how this asset should be valued, and how this asset should be allocated to. I've seen that again and again with newer types of assets. So I think that will change over time. When will it change? I don't have that answer, but I will say this, is that over the years that I have been involved with Bitcoin, the drivers of what drives the day-to-day volatility of Bitcoin have changed. So in the beginning, when I first got involved in Bitcoin in 2016, the number one driver nobody cared what interest rates did. The number one driver was whether China would ban Bitcoin mining or not. And so if somebody from the central bank in China said something negative about Bitcoin or blockchain, Bitcoin would drop 30, 40%. If they said something positive, Bitcoin would rally 30, 40%. But at the end of the day, did China really matter? No, because when China came out and essentially made Bitcoin trading and Bitcoin mining illegal, Bitcoin doubled in value. Not right away. Of course, it went down in June, and then all the miners moved their mining equipment, and then Bitcoin went to 70K. So, so my point is that the story, the narrative that drives the day-to-day volatility behind Bitcoin can stay in place for 2, 3, or 4 years and then change. So expect that it will change.
So that concludes today's episode. Thank you for listening. We'd love to hear your thoughts in the comments section. You can find the show notes on www.tikatiwari.com. If you found this episode helpful, please share it with others, talk about it on social media, and leave a rating and review. Don't forget to subscribe so that you never miss another episode. Thanks again, and we'll see you next time.